I want to start with what would make you less aggressively neutral? Are you starting to see the yields that can make you a little bit more comfortable with going into some of the longer duration bonds?
Yeah, well, great to be with you, Lisa. I don't know if I'm going to use the word comfortable with anything in this market right now, but the first thing I do when I wake up in the morning and to get a barometer on the markets is look at the 10-year, and we know the 10-year is kind of breaching this 5% level. I will say this, Lisa, and we talked about this last month. I mean, as we approach this kind of 5 to 5.25. We're reaching the highs from 2007. Real yields or inflation-adjusted yields are also around 250. That's kind of where the top was close to in 2006 to 2007. So, listen, not to try to be a hero, but I do think that as we kind of hit these areas, that there will be some more buyers stepping in. And if we step in and we just see yields stabilize, I think that will be enough to actually also see equities rebound. So instead of this case where stocks and bonds are falling together, they'll likely move up together. Again, as you mentioned, this is a big week for earnings as well.
Well, let's talk about that, because at some point we've got to get off bonds, right? I mean, I feel like every morning we wake up and we quote the 10-year, and then we keep quoting it throughout the morning, and that's what we do. We wake up and repeat it again tomorrow. At what point do earnings take the narrative over and say, hey, look at these big companies with cash performances that are just tremendous, that are continuing to consolidate market share, even perhaps the expense of all the smaller ones. Let's buy them, even though they're up, 150% if you take a look at Meta so far this year.
Yeah, I think that's fair. I think one thing that's being overlooked right now is, it's ironic that that the economy, the equity market's weakness is because the economy is too strong as opposed to too weak, which was the kind of the consensus coming into this year. And what's being overlooked right now, because of that strong economy, we just had for the S&P 500 forward 12-month earning estimates hit a record high. So again, I think that's being somewhat overlooked because there's so much attention on the 10-year. In our view, really just that stabilization would be enough if we stabilize in the 10-year to refocus on earnings. And the other thing is, we just did a note this morning, and we looked back at what was the average 10-year yield from 1950 to 2007, right, the pre-global financial crisis. The 10-year averaged about 6%. Cash yields were around 5%, and the total return for the S&P averaged above 11%. So stocks can do fine in that environment, but it's the adjustment process, and the challenge right now that makes it a bit more challenging is how quickly we've moved up. So we just need, again, a little bit of stabilization. I think they'll be refocused. And on the margin, as we pull back within that strongly or aggressively neutral that you said, we become a little bit more positive because at least you're reflecting some of these market uncertainties that's right in front of us.
All right, Keith, I've been wondering this for a long time. If you are strongly neutral, does that mean that you wake up every day, you look at the 10-year, you see if it's moved by more than 6 basis points? If it has, you roll over and you go back to sleep. Is that essentially what this means, or are you adjusting in real time around the different earnings that come out, as well as readjusting to try to capture some of the yield?
I might disappoint you, but no, we're not adjusting tick by tick. I mean, our tactical time frame is 6 to 18 months, basically. So we want to see something meaningful with that. We think there could be outperformance over a period of time. But where we really have focus, so yes, we're more neutral with stocks versus cash versus bonds, but we've been making big bets within asset classes. We've been Team USA all year. Look at the U.S. spread relative to international markets, especially emerging markets where we remain negative and we have zero allocation in our portfolio. So that's a way to pick up some, relative performance. We still think large caps over small caps make sense, not only because of what you just mentioned on kind of the tech earnings, but small caps have a lot more floating rate debt. They're much more sensitive to these higher rates, and the business cycle is working against them. So I do think there's opportunities there. And another market where you focus a lot, Lisa, we're starting to see those credit spreads start to creep higher. We do not think this is the time to take on credit risk. We would say high quality. And again, start leaning into that 10-year without trying to call the top.
Right now, we're just definitely watching also specific sectors, including oil. And this morning, we did see Chevron announcing an all-stock acquisition of Hess. How are you playing the discussion that people keep having that there's going to be much more consolidation in this sector, especially at a time when it's about maximizing the profits out of the ground before people don't want it?
Yeah. Well, listen, I just think in general, the energy sector is a good hedge in this market. We are overweight the energy sector. And the way to think about it is this. I mean, I think the lower end of the oil prices is higher than what it was. These companies are generating huge cash flow. And I think even today, the story with Chevron is a cash flow story. So they're one of the cheapest sectors in the market, and we're also seeing a lot of positive earnings momentum. So I would say, stay overweight energy. It's a good overall hedge, and I think the fundamental story is still positive, not just for this year, but it's a multi-year story.
When we talk about earnings, the fact that $15 trillion worth of market cap is going to be reporting this week, how much are you watching the underperformances and how punished they are by the market? By one measure, the disappointments were met with the biggest sell-offs going back since 2019 so far in the earnings cycle. Does that tell you something?
Well, it's a negative, right? And the other thing we're seeing is on top of that, even positive earnings have not been received well. So I think in some ways you could say, well, maybe all the good news is baked into stocks, and therefore they're looking ahead to a slower economy. And I think that's potentially true, but I think more likely is that during this earnings season, we've seen the 10-year move up so rapidly that people are just dismissing the earnings in totality, both positive surprises, and as you mentioned, even hitting the smaller companies more. So again, I'd like to see stocks react better to positive news, but I think that 10-year is really what's driving things more than the actual earnings today.